Today, and Justin, if you want to turn your camera on, we have Justin Wright from Financial Professionals Group with us. He is a life insurance and long-term care insurance expert. Justin is a graduate of UC San Diego. He graduated in 2010 with a bachelor's in political science, and then later went on to join Financial Professionals Group, which is what is considered to be a brokerage general agency, or a BGA. So it's kind of special that we have him with us today, because a brokerage general agency generally focuses on working with financial advisors, independent insurance agents, registered reps, and he was kind enough to come and talk to all of you today. When Justin graduated in 2010 and then ended up joining into financial services shortly thereafter, he very quickly completed the educational coursework to get the CFP, which is a Certified Financial Planner, the Chartered Financial Consultant, or ChFC, and the Chartered Life Underwriter, which is CLU. Now, all of those designations require extensive coursework. I'm not shy to say it took me about 2.5 years to get the Chartered Financial Consultant designation, the ChFC. Well, Justin, is being the overachiever that he is, completed all 3 designations in coursework so quickly that he did not have the time in the business. There's a business requirement that says you have to have at least 3 years of experience in the business in order to hold those designations. So he completed all the coursework, passed all the exams, all the tests, did it so quickly that he couldn't actually tell anybody that he had achieved these very prestigious designations. So that's a little bit about Justin for you, a bit of an overachiever. A little home life for you. He plays as the lead guitarist in a rock band, and he is currently on 3 roller hockey teams. So the guy's very, very active. With that, I will go ahead and turn it over to Justin, who's going to present on understanding long-term care needs and solutions for us today. Justin, go ahead.
Wow. Thank you, Josh, for that very, very kind introduction. So today we will be talking about a very important topic. It's understanding long-term care, the needs and solutions. And really, this is a topic that once it's fully addressed, you can truly finalize your financial plan. So the 3 takeaways I'd like you to have at the end of this presentation are understanding the need for care and the probability of requiring care, the current costs and future projected costs of care, and then also the solutions that you have available. So in discussing the need for care and really long-term care planning, it's a tough topic. You have to come to the realization of what your life would look like or will look like in the future. We're talking you're 80 to 105 years old. So you have to understand what you're going to require at that time, because right now you're young, you're healthy, you're able to do everything on your own, but you have to realize that in the future it will not be the same. So this is a tough conversation and a tough internal realization that you need to have when considering long-term care. So statistically speaking, 7 out of 10 individuals who are age 65 or older are going to require some form of chronic illness care later in life, or some form of long-term care coverage or anything like that. So that's 70% of individuals age 65 or older. That's quite an alarming statistic. And Josh, why do you think that number is so great and it's getting higher by the year?
If I had to guess, my guess would be that, statistically speaking, people are living longer these days. And so the longer that you live, the higher the probability will be that over time we may become frail and need some assistance with our daily activities.
So this is what's happening with medical breakthroughs. We are living longer, and as decades pass, it seems like the life expectancy keeps getting knocked up a couple more years. So people are living longer, and one of the big concerns is what you talked about, the frailty concern, as well as our brains aren't necessarily working as well as they used to the older that you get. And that's why the statistic is growing, because people are living longer. And to piggyback on that, so 9 in 10 people that require the care, they have permanent conditions. So only 10% of them will have a condition that is not considered permanent. So we would consider this like you broke your hip, you rehabilitated, and you needed help for a little while, and then you came off claim. But 9 out of 10 individuals will require care for the rest of their lives. And that would be going on claim. So that means that you can't perform 2 of the 6 activities of daily living. And these are bathing, dressing, eating, transferring from one area to another, toileting, incontinence. And then another category is severe cognitive disorders. So if you are diagnosed with dementia or Alzheimer's, then you would be able to file a claim as well. So we're looking at 70% of individuals age 65 or greater are going to require care, and 9 out of 10 of them are going to require care for the rest of their lives. And looking further, and this is kind of relatively basic economics, so the number of Americans who need long-term care will more than double by the year 2050. So in about 30 years from now, that baby boomer population is going to be in the elderly age in which they are going to require care. And what happens when you have twice as many people as today that require care, that require to get into the facility, require a care provider? What happens to the potential pricing with that influx of people that need the care?
Supply and demand, costs will go up.
Exactly right. So these are some of the looming concerns. We are living longer. We have to understand that, and we're going to likely need care more so in the future because of it. So on average,
question for you.
Go.
You know, if we think about the fact that there's this aging population, and it sounds like statistically there's a good amount of people that are going to need care. You know, if we're looking at today, right, and then of course we'd extrapolate that out in the future. But if we're looking at today, it looks like this is what you're going to ask next. I mean, where is on average that care coming from? Is this happening in home? Are people actually going into facilities? You know, how are people being cared for currently?
That's a great question. And really 8 out of 10 people who need long-term care, they live in private homes. So they are still in their house. They just need some extra assistance. They could need help shopping or going to the grocery store, making a meal, doing home maintenance, remembering to take their medication. There are a lot of different needs for home care. So I think that some people, they think on the extreme level when, oh, I'm not going to require long-term care. They think that it's going to require a wheelchair to be able to qualify for a claim. But in reality, it's a lot of the day-to-day stuff that could be helpful having someone take care of when you are in those later years. So most of the care is provided at home, and most of it today is provided by family and friends. And then nearly 2/3 of the family caregivers are females. So we're talking about the adult daughter who also has a family of their own, has children of their own, has a job of their own, and out of the kindness of their own hearts, they go and they take care of their parents or grandparents or whoever it might be. So this is kind of the thought of the burden of who is taking on most of the burden. Of course, the other siblings are helping to carry the weight as well. But on average, you have to imagine your children coming to take care of you if that's necessary. And I guess a lot of it comes down to, oh, I don't need someone to come take care of me. I don't want to pay the additional expense, or the daughter or the children might say, oh, you don't need to pay for someone, I'll do it for you. But that's where some of the solutions that we're going to talk about are going to help out and alleviate some of that burden in the future.
Yeah, these are tough conversations, but it's very real. I mean, these are real topics, and it does come up.
Right, definitely, and that's why it is a tough conversation. You have to really think of what the future would hold, and what's happening as well as the baby boomers are aging. The boomers had a lot more siblings because they had a lot more children back then, and then that generation had 1 to 2 on average. So therefore, you have fewer children to take care of you. So the statistic, it says by 2050, the number of available family and friend caregivers will be half of what it was in 2010. So generally speaking, you had someone there to take care of you, but the future, based on population, they're not going to be there. So you have to find the solution for it.
I think it leans even more into the whole idea and concept of the need is continuing to grow, right? And as the need's growing, the availability of care that's out there, it sounds like it's coming down as well, which could lead to and would reason that costs will likely continue to rise in the future.
That's correct. And these are some of the outstanding or extenuating type things that we're looking at from a statistical standpoint, just the population and having your kids take care of you. That was something of the past, and it's not going to be as readily available in the future, and you have to really consider that. So in looking at today's costs, I'm a local here as well. I'm in Orange County, so we're going to look at the averages in Orange County. And we're going to look at the 3 different levels of care. And this is kind of the first level of care. It's home care. So you're imagining someone, it could be a qualified care provider. It could be a friend or family member that you're compensating for their time to help take care of all these things. But they're in your home. It doesn't even need to be 30 days a month. It could be 20 to 25. But right now we're looking at an average of $4,500 per month for home care. And there are just a lot of day-to-day activities that you would love to have someone help you out with in the future, if it's within the budget. So that's the first level of care is home care. And as I mentioned earlier, 8 out of 10 on claim are in their home. So they're normally paying about $4,500 per month for that. And that's in addition to the regular expenses for that person to come and help them at home.
And so, just regarding the home care, I mean, how many is that every day? Is that a few days a week? For that average cost of care, how often is somebody coming to help care for somebody?
On that was on average about 20 to 25 days. So it isn't necessarily every single day. And I guess with the consideration of home care, there's a lot to it. And I'll speak, my wife's mom is a home care giver, and she helped a couple for a number of years. It's 5 to 10 years. And that couple, it's the husband passed away a few years ago, and now it's just her and the spouse that are there. So it's a matter, they're friends, they're companions. So basically, like, she's able to provide that need for her, and it enhances her quality of life. These are all the considerations, really. So that home care provider is very important, and it could be for a long period of time that you need to be able to pay someone to come and help you out with your day-to-day life. Now, the next level of care, it's assisted living. So we're thinking of a senior home. So they have their social and recreational activities. They technically have 24-hour supervision. I actually went in a senior home recently, and they have like those wall toggle things. If you fall in the bathroom, you can pull the string and someone can come and watch over you or kind of take care of you at that point. So these cost a little bit more. And on average in Orange County, we're talking $6,000 per month for the assisted living. And that's on average. So if you find a nicer facility, you could be looking at $7,000 to $8,000 per month today. And then the final level of care is a skilled nursing facility. This is kind of at the final life stages. So it is an inpatient rehabilitation treatment center. So you basically do have round-the-clock surveillance, and it's all doctors and registered nurses taking care of you. It's one of those, basically the hospital room, and you imagine the curtain there, and you're sharing a room with somebody. So obviously it's much more expensive at approximately $9,000 per month today.
So, with these, I think it's one of those things you would kind of want to also think about, the additional details that go into that, right? So if I'm in a facility, I'm no longer, at home, right? And so there are some expenses that would be expenses that I would have and costs that I would have if I was not in the facility, that actually go away because I'm no longer at home, between food and entertainment and some of the discretionary spending. So, I think that it's important as we think about this and we think about the costs of care, especially if there's 2 individuals, right? There's the monthly expenses we had before, right? And some of those monthly expenses may come down slightly or even substantially. But then we have this other side where there's a cost that's going up and increasing. So, I think it's important as we think about it, it's not always the case of what's my current expenses plus $6,000 per month, right? It can be a little, it can work out a little differently in between there depending on everyone's, situation.
That's right. Yeah. And I guess with the home health care, you're still paying all of your monthly utilities and all of your bills for your home. You're actually just adding $4,500 on top of it for someone to come and assist you. So that is something. And then if you're in an assisted living facility, I guess your spouse may still be at home, but normally you're both in the facility together. So it is a kind of a balancing act that it's not all in lieu of, but it could be in tandem with the regular expenses as well as these expenses, or it could be kind of just these expenses instead of just the normal expenses. So those are considerations, yes. And so we talked about the costs today. Now we're going to look at the projected future costs. And the real question is, will you be able to afford your medical care? And really, so one concern, and we obviously kind of touched on it, was inflation and demand. And what is a target inflation rate right now on the consumer goods and services? What is the Fed trying to achieve? And I know that Ben just released a nice article on that recently too.
Yeah, if anybody hasn't read the article that Ben released about a week or two ago on inflation, it was fantastic. I think it was last week. The Fed targets 2%. So whether or not we're experiencing 2% inflation, I mean, over the past 5+ years or so, it's really been under that. But that does depend on what metric you're using to determine what inflation is at. There's definitely different sectors of the economy where inflation is going to vary, outside of what that 2% target is.
Mm-hmm. And we're talking about the medical sector, so we can imagine what it is. And historically speaking, over the last 85 years, the inflation rate on medical or on medicine is 4.7%. And that's actually realistic, and we can understand that. We know how much prescription drugs are. We know what our doctor's bills have been looking like over the years, and we understand that medical inflation, we do have these great breakthroughs. We're living longer. We have a lot more capabilities today, but it comes at a price, and it comes at a greater inflation rate than the other consumer goods and services. So if we're looking at these three different levels of care, and we are inflating at that 4.7% over a 20-year period, so in 20 years from now, $4,500 for home health care would be approximately $11,500 per month. The $6,000 inflated at 4.7% for 20 years will be $15,000 per month. And the skilled nursing facility inflated by 4.7% over 20 years would be $23,000 per month. So these numbers, they do look, they're very high, obviously, because the compound inflation, it makes a huge difference, but this is the reality of what's occurred over the last 85 years. So I kind of broke down, like, what would a care circumstance or scenario look like? Let's say we went on home health care for 3 years. If we add that, and this is in 20 years from now, that would be about $414,000 to pay your provider to help take care of you based on this inflation rate. Then after that, let's go on an assisted living home for 2 years. That stay would cost $360,000. And then if we go into a skilled nursing facility, that would be $108,000. So that would be a 6-year long-term care event. And the total for that was $882,000. So we could see how that could have quite an effect on a financial plan, but there are smart ways that we can address this, which I'm going to be talking about now. And there are different options for long-term care insurance, and it's a matter of figuring out which type is best for you. And it depends on your overall financial plan, your goals and objectives, how much you currently have saved, how much you want to allocate to these plans. So I know everyone at Apprium does an amazing job, and they have full comprehensive plans, and we can really address these in the best way possible with one of these options. So the first option, and it truly is an option, it's self-insure. So if you haven't chosen to get any of these other types of long-term care insurances, you are deciding and you're making a decision that you are self-insuring. You're going to be using the dollars that you have in retirement, and you're projected to be able to cover all these expenses. Now, I'll be honest, when you have insurance, you're more than happy to use the benefits. You normally don't cut back when you have it. So sometimes with self-insurance, I can understand, I'm maybe speaking for myself, but I would cut back on a few things to compensate and not have to overly spend my money. So that's some of the consideration when you are self-insuring.
Well, self-insurance is
right.
It's probably the most widely adopted,
Mm-hmm.
right? But
Yeah,
it's either the most inexpensive or the most expensive option, depending on how things go, right?
That's right. The next level is traditional long-term care, and I'm going to go into some detail on these different types. This is what we normally think of when we think of long-term care insurance. It's a standalone policy where you just pay the premiums and you get a benefit. Then the next level would be the life insurance policy with a long-term care rider, where you can access that death benefit early to pay for long-term care expenses. And then the final and fourth one would be, it's called an asset-based long-term care policy, where you're repositioning. It's normally a lump sum type premium that we'd be looking at for asset-based long-term care, and there are pros and cons for each one, which I'm going to go into detail on. So traditional long-term care, the pros, it's the least expensive. You have plan flexibility, so you could choose your benefit amount, and it ranges from $1,500 to $10,000 per month that you can start with. You can choose your benefit period, so it's between 2 and 5 years that you can choose for traditional long-term care. And they have inflation options where the benefit will increase with inflation. So you could choose a $10,000 a month benefit, throw a 3% rider on there, and you're going to more than cover hopefully what those projected future costs would be. So you have inflation options, and then you have different elimination periods. And this is a period of time in which you need to be unable to satisfy the 2 of 6 activities of daily living, and it's normally about 90 days. So let's say that you go to the doctor on January 1st, and they say I deem you to be unable to perform 2 of 6 activities of daily living. Then at the end of March, or about 90 days later, that's when you're going to ultimately be receiving your benefit. But you can also make them longer elimination periods to 180 days to 365 days, depending on the premium that you want to pay. Some cons for traditional long-term care, it's a use it or lose it basis. So you could buy your policy, pay the premiums all these years, never go on claim, and there's no death benefit or any legacy benefit provided to your heirs. And then also another con, and this was more so in the past, the premiums are not fixed. They can increase. And this happened more so, I'd say 20 years ago, because even those big insurance companies didn't account for how long people were living. So they kind of messed up on their actuarial calculations and didn't realize that people were going to keep these policies and they were going to retain them much longer than they expected. All right, so that's the first type of long-term care coverage. The next one is a life insurance policy with a long-term care rider. And the first consideration for this, it's not primarily long-term care. It's for people that are charitably inclined. They want to give money to their children, church, charity, grandchildren. They have that as their first and foremost goal. And then they can add a rider on there that can actually allow you to access the death benefit early if you require long-term care. So the pros are you get a leveraged benefit to your heirs. And another pro with this, and there are different categories and work with so many different carriers that they have different features, but it's normally you receive a long-term care or you receive a cash benefit for your long-term care claim. And this is different from the other types of policies because the other ones are reimbursement, where basically you have to show that you spent the money, you hand it to the claims department, and they reimburse you for that expense. With a life with long-term care riders, they actually write you a check to the tune of about 25% of your death benefit at the beginning of the year. And you could use that check however you'd like. You can pay your grandchild to drive you to the doctor's office. You can add an addition down in your home so that it makes it easier to get around. So there are a lot of different ways that you could spend the cash versus the other ones that are a little more restricted because you need a qualified care provider and you need a reimbursement expense. And then you also have plan flexibility, so you can choose how much death benefit you want on these policies. And then the benefit period, it's normally about 2 to 4 years are the 2 different benefit periods that you can choose on these plans. The cons are that they're more expensive than traditional long-term care. You really have that leveraged death benefit that will be provided. So if you don't use a single dollar for long-term care, that's all provided to your heirs upon your passing. And then it's a little more extensive underwriting. So you're required to do a paramed exam, get blood, urine, height, weight, blood pressure, all of that. Whereas the other types of long-term care only require a phone interview and cognitive questions. And then the final one is asset-based long-term care. This is more if you have a lump sum type asset, if you have a cash position or a money market that you'd like to reposition and you'd like to get more leveraged long-term care, and it has some slight death benefit element to it as well. Pros, you get to leverage your existing assets for long-term care needs. Simplified underwriting, it's that phone interview. They take shorter premiums, lump sums, or up to premiums for 10 years. And the cons, it would be the opportunity cost. So you could take that money, you can invest it elsewhere, and hopefully you can grow it to a greater amount than the policy or the asset-based long-term care policy. So let's look at just some numbers and how these premiums would stack up. We're looking at a 60-year-old couple, so it would be covering both individuals. We're looking at a $6,000 per month benefit for approximately 4 years. Now, these products, they don't necessarily line up exactly apples to apples, so I have to explain some of the differences, but that's approximately what we're going to be looking at for these three types. Mm-hmm.
Could I just ask a quick question, because I saw it come up in the questions before. We talk about these different benefit periods, 4 years, 6 years, 8 years. How does somebody kind of determine, which of those benefit periods makes sense? Is there an average? Is there something that's closer based on, on average, how long people are actually in a care facility? How would you go through and kind of determine, which benefit period really makes the most sense? If you can get an idea of pricing.
Sure. On average, people go on claim between 3 to 4 years, so that is kind of the starting point. And then it comes down to budget and really how much we want to be paying into this plan. Because we could look at, okay, we have a 4-year benefit. It's going to cost $4,000 per year. If you want a 5-year benefit because you knew that your family history, your parents had a history of Alzheimer's or dementia, or your grandparents lived into their hundreds and needed care for a long time, we could be considering a 5-year benefit. So it is kind of circumstantial based on the average. I normally start with 3 to 4 years, and then we could go lower if we're trying to fit a certain budget, or higher if we want to accommodate kind of what the future might hold based on family history.
I think that's a great point. I think that really highlights the fact that when it comes down to this, while we're talking about averages today and the average costs, right, and the average stay and how long, those are based on averages to be good information that can work for a lot of people, right? However, everyone's situation is different. Like you said, you have family history, and your family history says, there's a good chance, that Alzheimer's runs in, my family. Therefore, Alzheimer, dementia, those types of stays tend to be significantly longer than the average. So I think it's something that, for anyone that's on the line that's considering, adding this piece of risk management, it's something that we should have a conversation with you. We should talk through and add it into your financial plan and talk about the best options on covering it. All right, I'll get off my soapbox. Go ahead, Justin.
No, all right, that was great though. That's exactly right. So in looking at this comparison, a 60-year-old couple, $6,000 per month, 4-year benefit. The traditional long-term care is $3,500 per month. So that's actually relatively inexpensive. If we're talking, let's say you paid that premium, per year. I'm sorry. So the annual, thank you, Josh, $3,500 per year. Let's say that we paid that premium for a 25-year period, and then even one person went on claim. We would be able to recoup all the money that we put in there within 1 to 1.5 years. And essentially, this pool of money for this premium, we're looking at a $576,000 combined pool of long-term care benefit for this couple. Now, it's good that they started planning early and started considering it at 60 years old. Oftentimes, I see people later at 70 or 75. It could still work, but obviously it gets more expensive as you get older. Now, the next level would be the life insurance policy with a long-term care rider. And this would have a $300,000 death benefit for each one of them. And we would have a 2% long-term care rider. So it would pay out 2% of the death benefit, which equals $6,000. And that would be for a 50-month period. So it's 4 years and 2 months. So it's slightly different than the 4-year period. We're looking at premiums for him at $5,800 per year, and for her at $5,200 per year. So about $11,000 per year compared with traditional long-term care. You'll see that is more expensive, but we have that legacy benefit. If none of these dollars are used, you can kind of look at it as a little more of a Cadillac type plan where you are paying for those additional benefits, and you get a cash long-term care benefit too. So that flexibility might be worth some of the extra cost as well.
I think that's an interesting point. I just want to interject for a second because I think it's important highlighting, the differences between these, right? And so while traditional long-term care is a lot less expensive, the complaint that comes up with that, and you mentioned it earlier in the presentation, but it's the whole, if I don't use it, I lose it theory or thought process of I paid these premiums. Nobody likes paying their insurance premiums for anything, right? Whether it's car insurance or health insurance or homeowners insurance, fire insurance, earthquake insurance, it never feels good to pay insurance. But it's definitely helpful in the event that one of those kinds of risks comes up, and we have the insurance there to help protect us at the time. But my point is that we could be paying $3,500 per year. We could pay it our entire life, never end up going into a care facility and never accessing it, right? Whereas with the life insurance, we're paying substantially more, right? $11,000 per year combined between the male and female. But if we don't use it, there is still at least something going back to our heirs, so those premiums didn't just go for nothing. And we had the long-term care protection along the way. So, Justin, if you want to pick up from there.
And oftentimes I see even younger clients adding that long-term care rider onto their life insurance policies. So you could be 40 to 50 years old, you get the life insurance because you definitely need it. You have kids that are still in the house or anything like that, and you just add the long-term care rider on there. And the sooner you get it, or the younger you are when you get the life insurance, the less expensive it is. So I'm using a 60-year-old couple here, but obviously it could work for younger individuals. Then finally, the asset-based long-term care. This is a single premium. You would reposition $157,000. It's all paid at once. There's no further premiums. It's fully guaranteed. It has a face amount, so there is a death benefit element to it of $198,000, but it has a lifetime long-term care benefit. So you could go on claim for 15 years. Both spouses could go on claim for 15 years, and you would be able to exhaust that policy and then some. So a lifetime benefit, that is substantial, and that is a strong consideration for people with family history of Alzheimer's and dementia.
And so between the asset-based long-term care policy and the other two options, is there a big difference in underwriting between the two, in the amount of time and effort that goes into that? I know that, life insurance with long-term care can be pretty extensive. How about the asset-based LTC?
That one's also a phone interview. So we can see these, you can submit an application, and they do have to pull up your medical records. They have to get the information from your doctors to be able to underwrite you. But there is no medical exam. It is a phone interview that's required. And that's the same with traditional long-term care and asset-based long-term care. That's just a phone interview. For the life insurance element, you need that paramed exam with all the blood and urine requirement. Now, really, in closing, final thoughts here, and this is something that I actually came up with recently, is that life, it's not a linear event, meaning that we looked at a lot of probabilities. We looked at statistics and what might happen, but that doesn't mean that it's going to happen. And insurance is really protecting against the future, which is uncertain. So right when you buy these policies, I know that you could be 50, 60 years old. We're going to hopefully tap into them maybe in the 80s or 90s, but it could happen sooner. I think we all have stories. We all understand that there are people that have required care. They have passed away, not at life expectancy. So we have to understand that. That's what insurance is for, and that's why it's important to protect against that uncertain future.
I'm going to go ahead and let's open this up here. And I'm going to go kind of back in time to the front here. Okay, so I know we kind of talked about average costs for long-term care. Do we know with those averages, that you were sharing with us before? The question is, what the cost for 81 and 83 years old for LTC. So I'm not sure if that's necessarily the cost of care or the cost of the LTC insurance itself, but would you want to kind of briefly touch on at those ages, what the costs look like there?
The costs at those ages, they are going to be much, much higher. It will be, they are kind of at those later years where I think after age 75 to 80, it kind of becomes cost prohibitive, but we can always look at it. I don't know off the top of my head, but we can definitely see what's available in those years. And I guess for those types of cases, I do see the life insurance with a long-term care rider added on there. So that is a higher premium, but it's because it provides that leverage death benefit as well. And life expectancy is obviously shorter at 81 to 83.
Is there any benefit in doing joint policies because you're commingling two lives, as far as being able to get approval?
For approval, it doesn't help out. So if one person doesn't get approved, then it doesn't necessarily help the other. But if you do a joint policy, you normally have a couple's discount, and that's true across the board for traditional long-term care and asset-based long-term care. There is no couple's discount for life insurance with a long-term care rider.
Okay. Let's see here. There was a question. So, kind of a question here. So home health care, I'm assuming this probably went off of some quick math. $4,500 per month for home health care, approximately, let's say 20 to 25 days per month. Does that map out to about $25 per hour as being the cost of care? I don't know if you know, go ahead.
It is approximately that, so $20 to $25 per hour to have your care provider. And it could be someone that's not qualified, but then when you come and you bring a nurse or anyone else that's a qualified care provider, that's where that expense could get up there. So that is correct on the average there.
Perfect. Okay, let's see here. Do you happen to know, okay, so Medicare has some benefits for home health care. Do you happen to know how many months those benefits are for? And
I had that. I can look it up. I don't know it off the top of my head. I know that Medicare also has some benefits for the skilled nursing facility, but it is a limited period of time. But I know that they are a little more stringent on what they offer in terms of which facilities and what your options are. So that is why you sometimes go with that traditional or any other type of insurance.
But however, just for everyone's benefit, anybody that did not join us for, I believe it was actually the last webinar that we did was with, that was for Medicare Essentials. If you go to our website, there is and you go to our webinar section in the website, you can actually find some details on HICAP. And HICAP is a great organization that you can go out to and you can get some Medicare consulting, and they can answer any of your Medicare questions. They're kind of a specific age that's there that you really start to go, okay, at this point, it probably no longer makes sense.
Normally 80 and above. So that's where it's tough to get a lot of leverage in those years or ages.
And is there a cutoff where they won't issue the policies?
Some of them cut off at 70, some at 80, and some upwards of 90. So it depends on the company, but there are cutoffs within these different companies.
Okay. I mean, and I think you've mentioned it before, but just for everyone's benefit, the older that we get and the longer we delay putting something like this off, it does get more expensive as time goes on, because statistically speaking, the older that we get, the likelihood of us actually using the insurance goes up. And so from the insurance carrier's perspective, they're going, hey, this is, the likelihood of us needing to pay this out is greater now, hence, the expenses themselves go up.
Yeah, and I guess to go off that is I've seen people put off getting insurance, and then, of course, they can't qualify in the future. So if you're healthy and young, then that is actually an ideal time to be able to get the insurance, because you're going to get the preferential rates.
Yeah, it's perfect. So this is a great question, actually. I think we'll probably have fun with this one. So the asset-based LTC policy, right? It has an implicit profit built in to the way that it works, right? And so the question is, could I mimic this if I just plan to set aside the same amount of money today myself for my wife? And since there's a 7 in 10 chance of one of us needing it, that would give some time for the growth and everything to accumulate. Essentially, this is the self-insurance question coming up. Mm-hmm. So what would kind of be some of the, the pros and cons of getting an asset-based policy as compared to just setting the money aside, investing it, and allowing it to grow, and knowing that, hey, the purpose of why I've set this bucket of money aside is to use for long-term care at some point in time. And if I need it for something else, great, it's there and I can access it.
Mm-hmm. Yeah, that's a great question and a great way to pose it as well, because you could invest the money and hopefully outperform whatever the total pool of coverage is. But with this and with insurance, it provides it on a guaranteed basis from day one after you pay the premiums. So you leverage those dollars, and if we're looking at $6,000 per month for a 5-year period or whatever they might need it, that's a large leverage asset that they will have immediately, whether it's in 10 years, 20 years, 30 years from now, you will have that coverage immediately. So, and it's 100% guaranteed as well by the insurance company. So there are, of course, market fluctuations that you're going to have to overcome. And when you're drawing the money out of that bucket, then hopefully it's going to be at a high point in the market. So those are some of the variables that you have to kind of endure if you're going to kind of self-insure and do it yourself.
I think, the tax benefits themselves can't be underplayed. Those are big,
right,
so we think about, if I'm just paying for long-term care out of pocket, I'm not getting the same kind of tax treatment as I get from a long-term care policy. On the other side of that as well is, with these asset-based policies, I put the money in there and there's growth, right? And when I pass away, if I didn't access or use any of that growth, that leverage up that occurred, that passes on a tax-free basis to my heirs. Whereas, if you're following any of some of the proposed, changes, and we think about setting those dollars aside and we have it invested, whether we have it invested in a piece of property or we have it invested in stocks or bonds or any kind of an asset, and I have growth where historically and technically right now, if I were to pass away and that passes on to the next generation, there's a step up in basis, which is fantastic from a tax standpoint. However, if that goes away, that stepped up basis no longer exists. And, that is proposed and on the table. So this would be, that would create a benefit as far as the tax-free death benefit could go. So, there's some, I think that plays a major role in the idea and the conversation as well.
And those benefits, they are qualified from the long-term care policy, so they are 100% tax-free. And really, when you're building the plan, I know that we looked at $6,000 and kind of supplementing potentially the whole amount. We're looking at their retirement income and looking to supplement the difference of what they need. So that's a logical way to build this into the plan. So if you know that they already have $10,000 a month that's going to be fixed, but potentially if you have a long-term care event, you might need 15, then you add the 5 on top. We don't get $15,000 of long-term care coverage just for the benefit of it. There is some logic in the planning element of it, and that's why the cash flow management is helpful in long-term care planning as well.
So would you say, is there a sweet spot for purchasing long-term care insurance, maybe 50 to 60 years old?
That would be kind of the sweet spot where it would make a lot of sense. If you go on claim in your 80s, you're going to get a lot of benefit based on compared to what premiums you paid into these types of plans. Perfect.
Okay, I think that wraps up the majority of the questions that we have. However, one of the participants had some great information just worth sharing with everyone. And so she said that she's looking into a home health care facility for her dad right now. And within the past year, the agencies have bumped their hourly rates from $25 per hour to last week is now $30 to $33 per hour. And this is not an RN, it's just home health aid. So I think that's very, very helpful information. I think, again, this comes into it depends on who you're talking to, what facility you're looking at. Well, Justin, any last final closing thoughts you'd like to add in there?
Thank you again for the opportunity to present to your clients, and thank you, Aprium. It's always a pleasure working with you, and I look forward to helping your clients out in the future.
Well, thank you for joining us today and educating all of us. There's also a follow-up email. Everyone gets the follow-up email, even if you filled out the survey. So just be aware, it comes to everyone, but it gives you an opportunity to click in there and get to the survey if you weren't able to do it after the event. So just want to, from the bottom of my heart, thank all of our Aprium family.